All right, welcome to this explainer. Today, we're putting on our professional sell-side equity analyst hats to conduct the absolute ultimate test of fundamental equity valuation models. We are going to run one of the stock market's most fascinating and frankly most baffling anomalies through a rigorous valuation gauntlet. The subject, Aurora Innovation, ticker symbol AUR. Our goal here is to dive into the data and see if standard valuation frameworks can actually make any sense of this company. To really set the stage, let's kick things off with a number that might just make your jaw drop. $14.4 billion. That is the current market capitalization for Aurora Innovation, based on our source data. That's the massive price tag the public markets have slapped on the equity of this autonomous vehicle tech company. Okay, now hold that 14 billion number in your head, because here is where the valuation challenge immediately starts. Contrast that massive market cap with their trailing 12-month revenue. It's just $3 million. Actually, let me repeat that. Not 3 billion, 3 million. That is the single consolidated revenue figure we have to work with from the source reality. And wow, the picture gets even more complex when we look at profitability. Aurora has a staggering negative net profit margin of 29,670%. To put that into perspective for you, for every single dollar of revenue they bring in, they are burning an immense mountain of capital. This extreme financial footprint really sets the stage for the massive hurdle any analyst faces when trying to fundamentally model this stock. So here is our valuation gauntlet for today. We'll look at the $14 billion paradox, test absolute models, assess sum of the parts applicability, evaluate relative valuation multiples, perform asset-based checks, and finally, deliver our valuation verdict. Let's dive right into part one, understanding the baseline of this $14 billion paradox before we even attempt to model out future cash flows. Look, these massive negative return metrics vividly illustrate exactly why traditional historical frameworks are just screaming warning signs right now. Return on assets, negative 36.97%. Return on equity, negative 38%. And most critically for capital allocation, return on invested capital is sitting at negative 94%. The company is actively consuming capital to build its technology, not generating historical returns on it. Which brings us right into our first major test in the gauntlet, absolute valuation models. Because in the world of fundamental analysis, cash is king, and these models rely heavily on predictable cash flows and dividends. Well, the crucial roadblock is immediately obvious the second we plug Aurora's data into standard absolute models. A dividend discount model? Completely useless, because Aurora has a zero dividend policy. A standard discounted cash flow model? That requires free cash flow, but Aurora's is negative $612 million. The residual income model? That requires positive net income, but they're posting negative $816 million. The traditional inputs simply do not exist today. So as analysts, we might pivot to an adjusted present value, or APV model. Basically, APV values a firm's operations as if it were all equity financed, and then separately adds the present value of tax shields from debt. This is a brilliant, standard workaround for companies with highly fluid or changing capital structures, where WACC is just too unreliable. But look what happens when we try to apply APV to Aurora. Because their debt-to-equity ratio is exactly zero, the APV tax shield is simply $0. To make this model work at all, an analyst must explicitly declare massive external assumptions. You'd have to literally invent 5 to 10 years of purely speculative positive free cash flow, assume a terminal growth rate of 2 to 3%, and assume a market risk premium of 5 to 6%. Without making these huge leaps, absolute models absolutely cannot output an intrinsic value for this stock. Okay, let's move on to part 3, the sum of the parts model. We'll see if we can value distinct business segments independently with different risk profiles. Maybe they have a separate software division, or hardware, or data services? Well, a sum of the parts valuation requires distinct, reportable business segments with segment-specific revenues and margins. But according to our source data, Aurora doesn't offer that. We're looking at a single consolidated $3 million revenue figure. Because of this, we just have to skip the sum of the parts model entirely. The source documents completely lack the distinct segment data required to perform it. Striking out entirely on absolute and sum of the parts models, we shift to part 4, relative valuation. This is where analysts typically compare a company's multiples to its publicly traded peers. Now, what's really interesting here is that the sheer magnitude of these numbers breaks traditional scales. The PE ratio is negative 16, But look at the sales multiples. The price-to-sales ratio is an astronomical 4,800. Just to put that into perspective for you, the market is currently paying $4,800 for every single dollar of sales this company makes. EV to sales is similarly massive at over 4,300.
And to actually apply relative valuation, we need comparable companies. The catch? The source documents list no explicit peers. Therefore, an analyst would have to totally guess and pull in external, pre-revenue autonomous vehicle peers. If you try to use traditional auto or software industry averages, Aurora would look infinitely overvalued. You're forced to compare them against other hyper-growth, zero-profit companies, which means your valuation is only as good as the market's current appetite for that specific, highly speculative sector.
So let's move to our final rigorous check in Part 5, Asset-Based Valuation. If earnings and cash flow are a total bust, let's see what the balance sheet tells us about its net asset value or liquidation value. And right here, we actually find a rare positive anchor for intrinsic valuation. Aurora has exactly zero debt. Even better, they have incredibly high liquidity. Both their current ratio and quick ratio sit at 11.86. This basically means they have nearly 12 times the current assets needed to cover their current liabilities. Their balance sheet is remarkably clean and highly liquid, which honestly is exactly what a company needs to survive a massive cash burn cycle. So how does this actually build into the valuation? Well, even with a brilliantly clean balance sheet, the market is pricing the equity at a price-to-book ratio of 6.6. This means investors are paying a massive premium over the firm's tangible net assets. If we calculate a pure net asset value, we find the market is essentially pricing in billions of dollars of intangible, future technological success rather than the hard cash and assets currently sitting in the bank. All right, after running all those numbers, it's time to bring all these models together for Part 6, synthesizing how a sell-side analyst must actually interpret this $14.4 billion company. Our valuation gauntlet reveals a truly fascinating reality. Literally every traditional model breaks down against the current source data. Absolute models rely 100% on external future assumptions because current cash flow is deeply negative. Sum of the parts? Skipped entirely. Relative models break traditional scales with a price-to-sales ratio of 4,800. And while the asset-based check shows a brilliantly clean balance sheet, it's still priced at a massive premium to book value. Why does this matter to you as an investor or learner? Because it perfectly illustrates a market environment where retail and institutional investors alike are perfectly willing to price pure speculative hype over current fundamentals. At the very beginning of our analysis, we noted a fundamental rule for sell-side analysts. You may supplement with reasonable, clearly stated assumptions when the documents lack required data. Well, what Aurora proves is that for hyper-growth, deep tech companies, assumptions aren't just supplementary to the valuation, the assumptions are the entire valuation. Which leaves us with this final provocative thought. When traditional fundamental models fail so spectacularly to capture a company's market capitalization, are we still measuring intrinsic value at all? Or are we really just pricing a collective $14 billion vision of the future? Thank you for joining me on this explainer. I hope this helps you look at valuation metrics in a whole new light.